Welcome along to your FinWell Daily Brief. It's Wednesday, June 18th, 2025, and this is our 63rd session together. Really glad you could join us as we unpack today's market action and some key financial insights. Today's numbers, well, they definitely tell a story, don't they?
They certainly do. And it was mostly a story written in red ink across the board today. Let's jump straight into the closing data. The Nifty 50, it finished at 24,798 tunnels. That's down 55.40 points, or 0.22%.
Okay, bit of a dip there.
Yeah, and the Nifty Midcap 150 followed suit. Closed at 21,358.50, down 102.45 points, which is a 0.48% decline.
So midcaps hit a bit harder.
A bit harder, yes. Even the Nifty Small Cap 250, it slipped to 17,143.60, down about 33.70 points, or 0.20%.
Yeah.
So overall, the Nifty Total Market Index, that saw a 0.25% drop, ending the day at 12,904.35.
Right. Broad-based selling, it seems.
Pretty much. And looking beyond equities, the 10-year bond yield, it actually edged up slightly to 6.38%.
Yeah, from 6.32%.
That's right. And that sort of hints at, maybe a weakening global risk appetite, perhaps linked to climbing oil prices we're seeing.
Ah, the oil connection.
Exactly. And then there's the rupee. It weakened against the U.S. dollar, hitting 86.55. That's a fresh two-week low.
Well, the pressure there.
Seemed to be persistent foreign outflows and, well, a generally strengthening dollar globally.
Wow. Okay. That's quite a snapshot for one day. So many moving parts. These numbers aren't just, abstract figures. What's the bigger picture? What's the story these figures are telling us today?
Well, I think what's really striking is how clearly these numbers show the ripple effect. The impact of global dynamics right here in India. The fact that all the major indices trended downwards, it's largely a direct result of, I'd say, two main international factors we've touched on.
Okay, which are?
Brent crude oil pushing towards $77 a barrel. That's significant. And the dollar index hitting a two-week high.
Right.
Now, for a country like India, a big net oil importer, when Brent crude surges like that, it directly inflates our trade deficit. And it puts immediate pressure on our inflation outlook and, potentially on the RBI.
Next time.
And at the same time, a stronger dollar makes all our imports more expensive, not just oil. Plus, it adds to the cost of servicing any foreign debt.
So it's hitting us from both sides there.
Exactly. These two forces together, they create this powerful headwind. It impacts investor sentiment, clearly, leading to the kind of broad declines we saw today. It's just a very clear reminder of how interconnected everything is in the financial world.
Absolutely. A vital connection to keep in mind. And, speaking of vital connections and maybe more stable things, amidst all this daily noise, it's good to remember the anchors, right? The things that ground our financial plans long term.
That's a great point. And it ties nicely into our financial fact of the day. It reminds us that government-backed schemes, like the NPS, National Pension Scheme, PPS, Public Provident Fund, and the SCSS, Senior Citizen Savings Scheme, they're still really the pillars of Indian household financial planning, even in 2025.
Still holding strong.
Absolutely. They offer this unique combination of safety, which is key, plus tax benefits, and, crucially, steady returns. They provide that bedrock for millions and millions of savers, year after year.
That is such an important perspective, isn't it? While we dissect the swings of the market day to day, these schemes offer that critical stability. It reminds you that real long-term financial well-being, it's often built on these kinds of consistent, reliable foundations. So for today's FinWell Daily Brief, here's what we've got lined up for you. We'll dig a bit deeper into those global pressures that pushed our markets down. Then we'll pivot to some actually quite surprising corporate success stories, proof that not everything follows the trend. We'll also put a new IPO under the spotlight, Influx Health Tech, and really unpack the potential risks there. And finally, we'll wrap up with a practical market outlook for navigating what's ahead and a really crucial warning for every single investor listening. Sound good?
Sounds like a plan.
Okay, so as we established, all the main Indian indices finished in the red. It really felt like those global currents were making some serious waves here. Would you say this was maybe more than just a minor blip, a signal of something deeper, maybe?
Oh, absolutely. I think calling it just a minor correction probably understates it. The pressure points were very clearly global and systemic in nature. You had Brent crude nearing $77 of a barrel. That's a pretty significant jump. And the dollar index at that fresh two-week high.
Right.
Think about it this way, right? For every dollar increase in crude oil, India's overall import bill just swells. And that impacts everything from government finances right down to potentially your household budget through fuel costs, other goods prices. And the stronger dollar just amplifies that, making imported goods pricier and also increasing the cost of repaying foreign loans if companies or the government have them.
So it really is that double whammy we mentioned.
It is. These two factors combined create a really potent headwind. It doesn't just dampen investor sentiment, it raises genuine concerns about India's import bill, the inflation outlook. It definitely signals a broader shift in market sentiment driven by these big macroeconomic challenges.
A tough environment then. Expensive oil, expensive dollar, really putting the squeeze on. But, and here's where the story takes a turn and it gets quite interesting. Not everything was painted red today. Even with all this sort of global gloom hanging over things, some companies actually managed to secure some pretty incredible wins, real bright spots.
That's always the fascinating part, isn't it? Looking beyond just the index level. While the broader market was struggling, individual companies were still executing on their strategies, signing deals. For instance, Polycab, they finalized a significant Viratnet project agreement with BSNL.
Ah, okay. That's big for infrastructure.
Huge. It's not just another contract. It secures future revenue and really reinforces their position in critical national infrastructure development. Then you had Railtel receiving a new order, this time from the Zoram Development Corporation. That indicates continued demand for their services in specific, maybe regional growth areas.
Okay.
And in the defense space, Virat Forge signed a crucial MOU, a Memorandum of Understanding, to supply UAVs, drones, unmanned aerial vehicles to the Ministry of Defense.
Wow, defense tech.
Exactly. And these aren't just small deals. These kinds of orders, they really boost optimism within those sectors. They highlight long-term growth potential and, importantly, sustained government spending in these vital industries. For these companies specifically, it gives them much-needed revenue visibility and reaffirms their strength in the market.
That's fantastic context. And speaking of wins, SRF had a major one today, right? Not about new business, but a really significant financial victory. Tell us about that.
Yes, indeed. SRF Ltd. reported a very favorable order from the CGST and Central Excise Commissioner over in Vadodara. What happened was, this order overturned a previous demand and penalty that had been levied against them, and the amount was, well, quite staggering.
How much are we talking?
Around 85.23 crore rupees.
Wow, 85 crore.
Exactly. It's a massive sum for any company. So having that kind of demand and penalty just overturned, it's a huge positive for SRF. It immediately frees up cash flow, releases capital that would otherwise have been stuck potentially in legal wrangles. It really speaks volumes about their perhaps financial and legal management. Definitely the kind of win that makes investors sit up and take notice.
Absolutely. From established players making these big moves, let's shift our focus now to something brand new hitting the market. Today was the opening day for the Inflex Health Tech SME IPO. They're aiming to raise about 58.57 crore rupees, with a price band set between 91 and 96 rupees per share. Now, whenever a new IPO comes along, especially on the SME platform, you really need to scrutinize things carefully. And for this one, there seem to be some notable, let's call them red flags, that investors really ought to be aware of.
You're absolutely right to highlight those potential red flags. SME IPOs, by their nature, often carry higher risks, so due diligence is paramount. With Influx Health Tech, there are definitely a few key points potential investors need to weigh up very carefully. First off, the minimum investment amount. It's quite high.
How high?
Retail investors have to commit over 1.09 lakh rupees per lot.
Oof, okay, that's not pocket change.
Not at all. It effectively creates a high barrier to entry. It limits accessibility for many individual investors who might normally dabble in IPOs with smaller ticket sizes. It means you've got to be prepared for a pretty substantial commitment right from the get-go.
Yeah, that definitely prices some people out. What else should potential investors be looking at closely here?
Another significant point is customer concentration.
Meaning?
Meaning a very large chunk of Influx Health Tech's revenue comes from just a small handful of clients. Now, while that might look efficient sometimes, it dramatically increases the business risk. It's like putting most of your eggs in just one or two baskets.
Right. Risky.
Very risky. If just one or two of those key clients decided to reduce their orders, or worse, leave altogether, it would have a massive immediate impact on the company's top line and probably bottom line too.
Right.
It makes the company quite vulnerable to issues specific to those few clients.
That's a clear vulnerability, yeah. And what about their profitability? Margins are always critical, right? How do those look?
Yes, margins are another area that warrants attention. The company's net profit margin, it was actually below 3% in the last financial year, FY24.
Below 3%. Wow, that's thin.
It is notoriously thin. It indicates that the business is highly sensitive to any cost pressures. Think about it. Any unexpected rise in raw material costs, operational expenses, even just small economic shifts could quickly wipe out profitability. It suggests a business that might find it hard to absorb shocks or even invest properly in growth without needing more capital constantly. Leaves very little room for error.
Very little buffer. Okay. And, a big indicator in the IPO world, often seen as a sign of institutional confidence.
Right.
What about anchor investors? Were there any big players involved
Well,
early?
that's a crucial point, and it's quite noteworthy here. There was an absence of anchor investors.
No anchor investors at all.
None reported. Anchor investors, as you know, are typically large institutional players, mutual funds, insurance companies who subscribe to a chunk of the IPO shares before it even opens to the public. Their participation is often seen as a stamp of approval, signaling strong institutional confidence after due diligence. It can also help stabilize the price once trading starts.
Right.
So despite what seems to have been some aggressive marketing for this IPO, the lack of any anchor investors, well, it can be seen as a red flag. It might suggest that these large, sophisticated investors who do deep dives perhaps weren't convinced enough to commit significant capital, and that could potentially dampen overall investor confidence when the shares actually list.
Okay, so bring all these pieces together then: the high entry costs, the reliance on just a few customers, those razor-thin margins, and no big institutional anchors stepping in first. What's the bottom line? What's the takeaway for someone listening right now who might be considering this IPO?
Well, my critical take would be this. Look, despite some reported revenue growth, the combination of factors is concerning. You've got the high entry barrier, making it inaccessible for many significant risks tied up in just a few customers, and those notably thin profit margins leaving little cushion. And the lack of anchor investors. It makes this influx health tech IPO, in my view, a high-risk proposition. Particularly for more conservative investors, it's absolutely crucial to understand these underlying structural risks before even thinking about investing. This is definitely one where you need thorough due diligence and, frankly, a high tolerance for risk.
That's incredibly valuable insight, especially when navigating new listings like this. Thank you. All right, let's zoom back out now to the broader market picture. We've talked about the global pressures, the specific company wins, the mixed signals from this new IPO. Given all these moving parts, what's the path forward look like? What's the general market outlook as we try to navigate these ongoing headwinds?
The outlook, I'd say, remains cautiously defensive, at least for the near term. We're still very much feeling the heat from those global oil price spikes and the strong dollar. The fact that the 10-year bond yield rose to 6.38% today and the rupee weakened to 86.55. These are clear signs that these external headwinds are still impacting liquidity and overall market sentiment.
So caution is the word.
Caution, yes. For investors, the guidance right now is pretty clear. Focus on quality, large caps. These are typically companies with strong balance sheets, proven earnings power, market leadership. They tend to handle volatility better.
Okay.
It's also probably wise to maintain defensive allocations. That means favoring sectors that are less tied to the economic cycle, things that hold up relatively well during downturns. Think FMCG, maybe IT.
Right, the steadier sectors.
Exactly. And crucially, it might be prudent to avoid highly leveraged mid-caps. Those companies carrying a lot of debt. They can amplify market moves both ways, but the downside risk is higher now. And also, perhaps steer clear of speculative IPOs, like the one we just discussed. They're just far more vulnerable in market downturns or when liquidity tightens.
Makes sense. Focus on quality, defensive positioning, avoid excessive leverage or speculation. And what are the absolute key things we should all be watching in the coming days and weeks? What signals will really tell us where things might be headed?
In the short term, there are three main things to watch closely. First, global central bank commentary. What are the Fed, the ECB, other major central banks saying or hinting about interest rates and monetary policy? That's huge.
Okay, central banks.
Second, oil price trends. As we discussed, this has a direct and significant impact on India's economy, so keep watching Brent crude levels.
Got it. Oil.
And third, keep a very close eye on foreign portfolio investor flows, FPI flows. Are foreign institutions putting money into Indian markets or taking it out? Consistent outflows often signal nervousness, while sustained inflows would suggest renewed confidence. These three central banks, oil and FPI flows, will be really critical in shaping market direction near term.
Excellent. Clear indicators to track. Thank you for that actionable advice. And finally today, something really important, a crucial beware for everyone listening. In today's complex financial markets, there are always dangers lurking beneath the surface. And one that maybe doesn't get enough airtime is something called cross-market manipulation. What exactly is this, and why should we all be particularly vigilant about it right now?
Yeah, this is important. Cross-market manipulation, it's essentially a sophisticated and illegal tactic used by some traders. What they do is they manipulate prices in one market segment, say the derivatives market, futures or options, with the specific aim of influencing prices in another related market, like the underlying cash market, purely to make a profit.
So gaming the system across different connected markets.
Precisely. It's like maybe rigging the odds in one part of a casino to guarantee a win in another part. They exploit the natural price links that exist between, say, a stock's price and its futures contract price. For example, they might place huge, maybe coordinated buy or sell orders in the futures market to artificially push the futures price up or down. They know the cash market price tends to follow the futures price, so they create this artificial move and then profit from positions they've already set up in the cash market based on that expected move.
Ah, I see. And how does this trickery, this manipulation, directly impact the average retail investor who's just trying to read the market, honestly?
Well, that's exactly where the danger lies for retail investors. This kind of manipulation creates completely false signals. It distorts the true picture of supply and demand. You might see a sudden, sharp price move or a huge spike in volume that looks like a genuine market trend starting a breakout or a collapse.
Right, looks like something real is happening.
Exactly. But in reality, it could be entirely artificially induced by manipulators. So if you act on those false signals without understanding what might be driving them, maybe you buy into an artificial high or panic sell into an artificial low, you can easily end up making unprofitable trades based on distorted information.
So the key really is vigilance, isn't it? And a healthy dose of skepticism sometimes. Don't just jump on every big move.
That's precisely it. Always try to verify unusual price or volume movements. Check across related market segments if the stock is surging. What are its futures doing? What about options activity? Look for confirmation. Question activity that seems anomalous or doesn't quite make sense. Don't just react impulsively to what looks like a dramatic shift. Protecting your capital really starts with being informed and, yes, sometimes being a little skeptical.
Crucial advice, thank you. And that brings us towards the end of today's FinWell Daily Brief. What an insightful session. We saw the Indian markets take a step back, clearly feeling the weight of those global pressures, rising oil, stronger dollar. But importantly, we also saw some fantastic corporate wins shining through from names like Polycab, Railtel, Bharat Forge, and that big financial victory for SRF. Proof that opportunity still exists. Then we took that necessary deep dive into the Influx Health Tech IPO, carefully uncovering those significant risks, especially for conservative investors. And we wrapped up with that vital market outlook, stay defensive, focus on quality, and the critical warning about being aware of potential cross-market manipulation.
Absolutely. And if you found this discussion useful today, please do make sure you subscribe to the FinWell Daily Brief podcast. We're here every day with these insights.
Yes, please do. And remember, for any personalized financial guidance, or if you have specific questions, you can always reach out and contact SOS FinWell on LinkedIn. We are genuinely here to help you navigate your own financial journey.
And as we close out today, let's leave you with this piece of timeless wisdom. A sound investment strategy is more about discipline than prediction.
So true. Just a final note, this report is for informational purposes only. Market data is sourced from SEBI-registered exchanges and regulatory filings. Always consult with a certified financial advisor before making any investment decisions. Thanks so much for joining us on the FinWell Daily Brief today. We look forward to having you back with us again